Hello and welcome to today's webinar. My name is Brenda Hutchinson and I'm the partner of the Superannuation Advisory and Audit Division at TAG Financial Services. Today we're going to be talking about trustee training. So to be the best trustee, and you owe it to your retirement. It's an important topic that you need to be for anyone who has a self-managed super fund or is thinking of starting a self-managed superannuation fund. All of the requirements and responsibilities that you're required to have and to be on top of to make sure that your superannuation is performing for the best way for you that it possibly can. So this information is going to be general in nature only and should not be acted on without first seeking professional advice. This information session is in no way to be interpreted as a recommendation or advice, and there may be information that is not relevant or appropriate to your particular circumstances. So running a self-managed super fund, what are the requirements, what do you need to do and what do you need to be on top of? Well, one of the things is that you need to really be on top of all the legislation and the rules regarding what you can and can't do in your superannuation fund. And how do you do that? It's really important that, most of us don't have time to be sitting and reading the legislation and keeping up to date with all the changes that occur in superannuation, and particularly for this year there's been a lot of changes. So how do we keep up to date? Well, it's really important that you actively ask questions. So, as you see something in the news, or someone may mention to you a particular topic in relation to your superannuation fund, jot those questions down, and next time you're speaking to your advisor, raise them, and if you don't understand, make sure you keep asking the questions until you do get the answer that you need and that you understand and that you can act upon. It's really important that you also establish fantastic relationships with your advisors. Now, when we're looking after superannuation, there's a number of different advisors that that you're dealing with. So there may be your accountant, there may be your financial planner, there may be someone that you're dealing with at the bank, you may have a legal provider. There's a lot of different people who are advising you, and each of those advisors has different technical abilities and technical expertise, and so it's knowing who to go to for which particular question, and make sure that you develop a good relationship with them so that you can ask them the pertinent questions that you need to make sure that you're running your self-managed super fund as that you need to. Each superannuation fund, when it's set up, has a trust deed, and along with a lot of other information that you have there. Now, when you've sort of set up your self-managed super fund, you probably received a big folder of, that contained a lot of documents that you needed to sign when you first started. So one of those documents is the trust deed, and this is the most important document that you have for your superannuation fund. It tells you what you can and can't do in the super fund in relation to a whole scheme of different things. So, what you can invest in, when you can accept contributions, when you can start paying out benefits to members. All of those different things are going to be included on there, and, sort of really provide the rules for what you can and can't do. As such, it's important that you treat the trust deed like the title to your home, so it's a very important document. Now, if you've got an accountant or financial planner that's helping you look after your superannuation fund, in a lot of instances they will keep the compendium with the trust deed at their offices. Sometimes you may keep it at your home, so make sure you keep it in a safe place. If you've got a safe or anything like that, well worth keeping it in there. Now, I also have had questions in the past, is it possible to keep soft copies of these, so copies of them in your, say, if you've got saving documents in the cloud or anything like that? It is okay to have those, and quite often when you're doing new investments or those types of things, and you might be sort of going for a loan because you're going to do a borrowing in super or such items as that, the investment managers or the banks will probably ask to see a certified copy of the deed. So if you are going to save it in the cloud, it's well worth getting your advisor to certify that it is a true true copy of the original. Then that can be scanned into the system and you can keep them on file there. Now just remember, if you are updating your trust deed, it's important to make sure that you've got all those copies of the trust deeds, particularly the most up-to-date one, and that you do keep copies of all those trust deeds as well. Now sometimes when you get your trust deed amended or updated, it can be either a full amendment of the document or it might be just certain parts of it are being amended. So I do recommend keep all of the copies so that you've got a good chain of events of what is the most up-to-date copy of your trust deed. Then when we're looking at running the super fund, we need to think about who is the trustee and what are your obligations and what do you need to make sure that you're doing. So the trustee of the fund is the person that essentially makes all of the decisions regarding the fund. So decisions regarding which investments you'd like to take part in, decisions regarding can we pay benefits out to members, so for example either a pension or a lump sum benefit, decisions regarding whether the fund can accept contributions. Now in a self-managed super fund it can be a little bit strange because quite often you'll be acting in two capacities. So a self-managed super fund is limited to have 4 members in the fund, and all 4 of those members, or up to the 4 members, they must all be trustees. Now we can have trustees that are either individual trustees or trustees that are directors of a company and the company acts as trustee of the fund. So as I said, they'll be, so whilst you may be the member, you'll also be the trustee, and in that circumstance you're wearing very different hats. So as trustee you're making decisions for the fund that's going to impact on the benefit of the members. So you know, you might be looking at a particular type of investment and considering, well, is that going to be for the benefit of that member? Is it going to, you know, go up in value? Is it going to pay us an income stream? All of those types of things. So you are acting in very different capacities even though you're one in the same person. Now, as I said, you can have up to 4 members in a self-managed super fund, but you can also have a single member fund. So you've just got a fund set up for yourself. You've got your contributions coming in and, you know, potentially at sometime down the track benefits going out, and you're making your investment decisions. Now where you've got that situation, if it's got a corporate trustee, so a company acting as trustee, it can be a single director that is, and being yourself, that acts as the trustee of the fund. Now if you are going to have individual trustees, you must have more than one. So you must have 2 if it is a single member fund. Now you may ask the question, well, why is this different? Why can we have a single director where we've got a company but we need 2 if we've got individuals? Now the reason behind that, when you think about superannuation, it's often the biggest investment that somebody has outside of their home. So there's a lot of money, particularly as you've accumulated over a number of years, it becomes a very good, very big asset. So it's important that the decisions that are made around the assets within the superannuation fund are looked after in the most appropriate way possible. Now to do that, what the government says is that if it's just you acting as yourself in an individual capacity, you may be swayed to make decisions that are potentially not in your best interest or potentially sort of go outside the rules in relation to superannuation. Now you might sort of then say, well, why wouldn't you do that if you were the single director of a company? Now what happens there is you've got another layer of legislation, being the legislation surrounding from the Australian Securities and Investment Commission, that adds on top of those layers. So they say with that extra layer of legislation and rules that you're required to abide by, that in that circumstance we've got that situation covered. Now, it's an important thing, and this sort of might sound a bit strange for a self-managed super fund, because generally a lot of self-managed super funds are mum and dad in the fund together. I've got the comment here that trustees must act together and they must act in the best interests of all members. Now, that's bigger than just self-managed super fund, because you also think there's a lot of industry or retail or corporate funds where quite often the trustee is an independent body of trustees acting on behalf of the members. So it's important that all decisions are made in the best interests of members. Now, you're probably going to think if it's mum and dad in the fund, they're the trustees of the fund, well, more than likely they're going to be making decisions in the best interests of the fund, of the members, I should say. But what we have seen is some cases that have gone through the court system where that hasn't happened, where, it might be mum and dad and two children in the fund. So, the children, sort of gang up on mum and dad and sort of sign off an investment decision without mum and dad knowing, or vice versa. And, you've really got to think about, well, were those things done, in accordance with everybody and everybody agreeing to them. We've seen some situations where, a particular member and trustee of the fund has done something they shouldn't have, like, for example, they've pulled money out of the fund before they're entitled to and disappeared with that money, and the remaining trustee is left to deal with the consequences of that, and that can involve penalties and those types of things. And the courts don't look at it, well, I didn't know what that other person was doing, therefore sort of almost pleading ignorance in that circumstances. The courts won't accept that as an excuse. Essentially, it will be whoever's the remaining trustees, which will be the trustee that's done the wrong thing as well, but, quite often they've disappeared and you can't sort of get a hold of them. So the trustees that are remaining do get lumped into that situation because they are supposed to be acting together. Now, one thing to be very mindful of in this particular circumstances, as I said, doesn't necessarily happen as much with your mum and dad fund, but where you've got the situation where it might be two business partners have a fund together and they might have, for example, purchased the business premises in their superannuation fund and are operating their business out of that. Now, other than being business partners, yes, they might be friends or whatever the case may be, or they might be family members, but where you've got two business partners where essentially the only connection is that business relationship, you want to make sure that you do think about those other members and trustees in the fund and how the decisions are going to impact on those. So you do need to beware. There is big penalties that can apply for superannuation funds. Now, the worst case scenario for a superannuation fund is for the ATO to step in and make the fund non-complying. Now, that's the highest level of penalty that can apply. Now, for a superannuation fund, the tax rate is a maximum of 15%. So it's a very tax concessional environment, which is why we tend to use these for our retirement planning and these types of structures, because it gives us the most tax effective way to accumulate your wealth for your retirement. Now, if your fund is made non-complying, in the first year that it's made non-complying, you lose 45% of your assets as a tax penalty. So not the income that you're receiving, the assets of the fund. And then from that year on, all of your income is taxed at the 45% tax rate, so the top marginal tax rate, as opposed to that 15%. So as you can see, in one foul swoop, you can lose, just about half of your accumulated assets. So you do need to be very careful. Now, in 2014, due to the ATO not really having any powers other than do nothing or make funds non-complying, and it has to be a fairly bad situation for them to make the fund non-complying. They did implement a whole new level of penalties that apply to the trustees of the fund. So essentially they're a monetary penalty. Now, when you're having your fund audited each year, the auditor will look and see, have we complied with all of the requirements that they're required to sign off on. And if you haven't, if you've breached one of the sections of the legislation, then the auditor will be required to qualify the audit report and prepare what we call a notice of contravention. And that gets lodged to the tax office. Now, what the tax office now has the ability to do is as soon as those notices of contravention are received, they can apply a monetary penalty straight away to the trustee. The monetary penalty applies per trustee. So if you've got a corporate, so a company acting as trustee, the penalty will be applied just once. If, however, you've got individual trustees, the penalty will be applied to each trustee. So if you have got 4 members, 4 trustees, what you're going to see is that penalty applied to each of those 4 trustees. So we used to, when that change was first announced, we had a lot of people saying to us, well, should we implement a corporate trustee straight away to avoid that situation? And I did say, no, we should avoid actually breaching the legislation, but there is other benefits of having corporate trustees that you might like to think about, for example, from a estate planning perspective. So don't just do it on the basis that penalties may be applied. Now, just to give you an indication, so for the amount of the penalty is dependent on what the breach is. The highest level of breach results in a penalty of around $12,200. So as I said, that would be applied against each trustee. Now, the sole purpose test, the overriding principle of superannuation is that you are accumulating wealth for your retirement to pay beneficiaries on your death, so to pay out a death benefit to, say, your spouse or your children as an example, or to pay you a income stream or a lump sum if you were to become disabled. So really everything that we do with superannuation must keep this test in mind. So when you're thinking about, do I undertake that particular investment, thinking about, is that going to provide for my retirement? So every time we're making a decision in the fund as trustees of that fund, we need to keep this test in mind. Now, this is actually one of the tests that the auditor is required to sign off on. So when you are making decisions, regarding investments, to accept contributions, all of those types of things, we need to document that we've thought about that test. So you would need to show that there's, documents and minutes to show that, yes, I have considered it and we've made the decision to go ahead on that particular basis. Now, I sometimes get asked the question, because the main sole purpose is to provide for your retirement, well, once you reach retirement, does the sole purpose test then effectively end? The answer is no, because it is also in regard to potentially after we've passed away, so hopefully that's quite a while after our retirement, that you're still, preparing and making decisions that will be for the benefit of your beneficiary. So it doesn't stop just as soon as you get to retirement. The other point I've got on this slide is in relation to there should be no immediate monetary or non-monetary benefits. An example of that would be, say that you're considering buying a painting that's going to be held in your superannuation fund. Now, you might be, an expert in artwork. You buy a well-known artist that you know is going to go up in value. So when you're thinking about that particular investment, you're thinking about, yes, it's going to provide for my retirement because I'm going to either, sell it and make a large profit, or it might be I'm intending to lease that to a gallery, so I know that there's going to be an income stream generating and, increasing the balance of my fund. Now, that same painting you couldn't hang in your lounge room. So in that instance, you are getting an immediate benefit from that particular asset that you're as such not entitled to. So now sometimes when we look at the sole purpose test, there's what we call ancillary benefits. So, you might sort of undertake a particular investment because of the sole purpose of providing for your retirement, but there may be some other little side benefits that come from that which don't override the fact of the sole purpose test. So an example of that a number of years ago, when you used to buy Coles Myer shares, for example, it used to come with a discount card that you could use for, when you're shopping at Coles Myer. Now, the sole purpose of perhaps buying those shares was, yes, I think these shares are going to go up in value, I think they're going to pay me a good income stream, but there was that little ancillary benefit of the discount card. Now, that doesn't mean you've breached the sole purpose test, it just, it goes along with the ancillary purpose, but everything that we do, we need to make sure that sole purpose test is being satisfied. Now, the ins and outs of superannuation. So trustees have responsibilities with regards to what we can accept as far as contributions, so money coming into the superannuation fund, and then also what's going out of the superannuation fund, so the paying of benefits to members. So firstly, the accepting the contributions. With contributions, there's a couple of different types of contributions, and we also have limits on the amounts of contributions that can be received. Now, you do need to be careful because as of the 1st of July 2017, so as of next week, the changes are there's changes with regards to the limits. So you need to be careful that we don't go over those limits, because otherwise we can have a situation of excess contributions. So there's basically two types of contributions. We have our concessional contributions. These are the contributions, so when you think of your superannuation guarantee, so your employer making 9.5% contribution of your salary, that falls into the concessional contribution category. Also, where you might have a salary sacrifice arrangement with your employer. So you might sort of say to your employer, yep, pay my 9.5%, but then I want you to take an additional $100 a week out of my pay and put that into my superannuation fund. So that's considered salary sacrifice. It's also considered a concessional contribution. So as those contributions go into the superannuation fund, they'll have 15% tax paid on them. So they come from pre-tax dollars that you hold outside of superannuation. Now, the limit currently for the 2017 financial year is that if you're under 50 years of age, you can put in $30,000 per person per year, or if you're over 50 years of age, you can put in $35,000. Now, that limit is a per person. So if you've got balances in multiple funds, the limit is across all of those funds. So you don't have say the $35,000 per fund. It is a per member. So do be careful of that. Now, as of the 1st of July 2017, that limit is dropping down to $25,000. So that's going to be a flat rate for everybody. Doesn't matter how old you are. So if you've currently got salary sacrifice arrangements in place, well worth talking to your employer, because you'll probably need to reduce some of that amount that you're having go into the superannuation fund. Now, our other type of contribution is what they call a non-concessional contribution. This is money that comes from after-tax sources and is paid into the superannuation fund. So if you're, you might receive an inheritance, for example, you might have sold your home and you've got some excess capital there that you could put into the superannuation fund, a number of different things. You might just have some investments outside of super that are returning more than you thought, or you sold some of those, so you've got some excess money, and so you put that into the superannuation fund. Now, that goes into the superannuation fund tax-free. The limit for these is currently, for the 2017 year, is $180,000 per person. So again, not a per fund. If you've got multiple funds, it is a per person or per member limit there. In last year's budget, so the 2016 federal budget, they announced that they were going to change that limit to a $500,000 lifetime limit, and it was going to be retrospective back to 2007. So if you'd put in $500,000 between 1st of July 2007 right up to budget night 2016, then you wouldn't be able to put any more in. Now there was quite a big uproar about this, and so when the government sort of put the legislation through, it did change. So it works the same as our current system, but the amounts are just going to be reduced as of the 1st of July 2017. So from that $180,000, it is dropping down to $100,000 per year. Now there is transitional provisions based on what you've popped in as non-concessional contributions in the 2015-16 financial year and the 16-17 financial years, and what will carry over into the new regime there. With the non-concessional contributions, if you're under 65 years of age, you can also bring forward 3 years of contribution. So with our new limit of $100,000, you will be able to bring forward three years worth, so put $300,000 in and then not put in any further for the remainder of that 3-year cycle. If you're over 65, you won't be able to use the bring forward. So if you did trigger it just before you turn 65, you can sort of put in up to that 3-year from there, but there's certain tests that need to be satisfied. If you're between 65 and 75, you also need to satisfy a work test, and the trustee needs to essentially sign off on that. And that work test is that in the year that you're making the contribution, you must work 40 hours in a continuous 30-day period. Now, if you're over 75, unless there's an award that dictates that you must put contributions in and you're still working, you can no longer make contributions. In this year's budget, they did introduce a new type of contribution which is going to be quite beneficial for people. So if you're over 65 years of age and you've downsized your home and you have lived in that home for at least 10 years and it was your principal place of residence, from the 1st of July 2018, you'll be able to make a one-off contribution to superannuation of $300,000 per person. That will be a tax-free contribution as it goes in, and if you're over 75, you can still make that contribution, and you also don't have to satisfy a work test. So if you're retired, you will be able to make that contribution, which is an exciting way for us to be able to increase our superannuation balances. There's a couple of new terminologies that have also been introduced as of the 1st of July 2017. The first one is our transfer balance cap. Now that's in relation to pensions, which says we can't have more than $1.6 million in pension mode, which I'm going to talk about a little bit later. The other one is our total superannuation balance. Now, as the name says, it's our total super balance, so it's our balances across all funds that we hold, so not just a particular fund. And again, if your total super balance is more than 1.6 million, you're not going to be able to make any more tax-free, so those non-concessional contributions. So that's just going to be wiped out completely. You will be able to still make the $25,000 concessional contribution even if your limit is over that 1.6 total super balance amount there. Now I've got their excess contributions, so if you do go over these particular limits, there's excess contributions that apply. So generally the excess contribution will be pulled out of the superannuation fund, will be taxed at your marginal tax rate, and then will then have an interest penalty applied. And quite often the interest penalty will be for 2 years, because it's from the 1st of the July in the year that you made the contribution. So even if you made the contribution on the 30th of June, the penalty will apply for that full year, plus until the situation is resolved essentially. So generally we'll find there'll be a 2-year penalty. So you really don't want to go over those excess contributions. The other type of money we can accept into the superannuation fund is our rollovers and transfers. So this is where we've held money in different superannuation funds and we would like to roll it over into the superannuation fund. Now it's the trustee's responsibility to make sure that the fund has an ABN, Australian Business Number, and that it also is able to accept these rollovers. So if those conditions are not met, the trustee's not not going to be able to accept them. Now generally in most instances as the rollover comes into the superannuation fund, it will be tax-free at that point. Now the other, so moving on to money coming out of superannuation, so paying benefits to members. So I've got there the point preservation. Now these are some rules around making, you can't access your superannuation while it's still in that preserved status, if you like. So what we see, generally all money coming into superannuation now is preserved, and so until you meet a condition of release, which I'll talk about shortly, you can't access that money out of your superannuation because again it's there to provide for our retirement. There may be some of you that have old components called unrestricted non-preserved amounts. These tended to come from old government funds. We don't see them anymore. We haven't been able to put sort of anything other than preserved in for about 10 years. So if you do have one of those old unrestricted unpreserved amounts, you can pull those out of superannuation at any point in time, no matter what your age is. So that gives you some good benefits there, although there may be a tax consequence of pulling that money out. Now, in relation to being able to pull your money out of the super fund, the trustee is required to make sure that the member satisfies the conditions of release and then give their approval that yes, that they can start making a payment. Now, the main condition of release is reaching age 65, so automatically you have met retirement by meeting age 65. Another condition of release would be death or disability, so you've met the criteria for those. You know, you can sort of fairly easily see if you've died, obviously, or you know, sort of someone in the fund has died. But you know, for disability there may be extra requirements regarding sort of getting information from medical practitioners and so forth like that. Then if you're under age 65, there's some conditions around whether you have essentially met the definition of retirement. So if you're between 55 and 60 years of age, you must have left gainful employment with no intention of going back. So if you meet those conditions, you can start accessing your superannuation. If you're over 60 and under 65, if you've had a change in your working arrangements, you can essentially start to access your superannuation. So me, for example, work for TAG. If I left that and went and set up an accounting firm on my own, I've changed the arrangements of my current position, my current gainful employment, so I would therefore meet that definition and then be able to sort of go on from there. The types of benefits that can be paid, essentially we have two types. So we can take a lump sum, which is essentially a one-off amount, or we can start an income stream, so a pension. Now where we do start those income streams, the assets supporting that income stream, the income on those is taxed at the 0% tax rate, not the 15% tax rate, so up to a limit of 1.6 million, which is going to start from the 1st of July 2017. Also with regards to preservation and the conditions of release, a number of years ago they implemented a transitional period. It used to be that you were able to access your superannuation from age 55 if you met certain conditions. They're slowly implementing that up to age 60. So the relevant dates to look at for that is whether you were born between 1961 and 1964. So if you were born in 1961, you weren't able to access your money until you turned 56, and as you step through those years up to age 64, it will slowly increase the age at which we can start to access the superannuation. So you do need to be careful. It's not an automatic 55. I also often get asked the question, is it from age 67, which ties into the ages that Centrelink holds. So no, it's a completely separate, different lot of rules. You can start accessing your superannuation potentially even though you may not be old enough to get an age pension or a card, an income card or health card or any of those seniors cards from Centrelink. So different sets of rules that apply there. So some of the investment restrictions that I wanted to talk about, and again, so as the trustee of the fund, it's your responsibility to make sure that you know the rules in relation to the different types of investments that you can do and whether the fund is meeting those criteria. If you don't, as I said, in the audit scenario, you're going to breach the provisions there and the provisions of the legislation, and so you'll get a qualified audit report, and there may be some penalties that are applied there. So pretty much in superannuation funds we can do a lot with regards to investments, but there is some restrictions that the ATO and the government apply, and the reason they've put these restrictions, remember back to when we were talking about the sole purpose test, it's in relation to those. So what they're concerned about is that they need people to be able to provide for their retirement, so they don't want them to put unnecessary risks around the investment decisions, which would mean that a lot of superannuation members lose their entire balances, or a good proportion of their balances, and then will be reliant on the government for financial assistance into their retirement. So some of the main rules that we need to be aware of are loans and financial assistance to related parties. So you're not allowed to make a loan to yourself, so you can't use money out of the super fund, and provide to the children, give them a loan, so they can buy a first home or anything like that. Or you can't, you might have your own business. You can't make a loan to that business. Now, there is very, very limited circumstances where you can do these things, but I would work on the assumption that you can't. So, sort of make sure that we're sort of documenting that. Acquiring assets from members. So if I hold an asset outside of superannuation, there are certain circumstances where I'm allowed to have my fund buy that that investment from me. So example, say I had a residential property, I might have a holiday home or an apartment that I'm leasing out and things like that. So in that instance, the fund is not allowed to acquire it from me. The only things that are allowed to acquire are listed shares and managed funds. They can be listed on any stock exchange around the world, so it doesn't have to be just the Australian Stock Exchange, or what we call business real property. Now that's property that's used 100% for business purposes. It doesn't need to be your business. It can be being used by someone entirely different, but acquiring those two types of assets is permitted. Now you might sort of have the question, well, why can you acquire a business real property but not a residential property? Now basically it's just what the legislation says. So somewhere along the line I think someone's probably transferred in a residential property and lost all the sort of lost the money and didn't maintain it, didn't provide for their retirement, and so the law has been changed in that regard. Now, as far as borrowing in superannuation is concerned, we've been able to do this for about 7 years now, so it's a relatively new investment concept in self-managed superannuation funds. It does apply to all superannuation funds, but you'll just tend to find that your big industry or retail or corporate funds won't allow you to do it, more so from an administrative perspective. So not so much around that they're not allowed to do it, it's just those administrative requirements make it a little bit difficult for them. So if you are looking to do borrowing in super, there's very strict rules on what you're allowed to do. You're also not allowed to use the other investments in the superannuation fund as security for that borrowing. So for this reason, it must be structured in a very particular way. And if it's not done like that, you can have stamp duty, capital gains tax implications when the asset sort of finally is paid off and transferred into the superannuation fund. Now with borrowing you can lend from a related party. So I mentioned up before we can't loan to a related party, but in this case we can lend from a related party, but we just need to make sure that it's all above board, almost like that you are dealing with the banks in these particular sort of types of transactions. Now with it is getting quite difficult as far as dealing with the banks regarding these types of investments. A lot of banks are pulling out of this space. They don't want to be a part of it anymore, but we just need to make sure all the correct structures are set up for what they need to be to make sure we don't breach the legislation in that regard. Now, our investments in related parties, so I mentioned before you might have a company that's doing very well and you'd like your super fund to invest in the capital to sort of provide some equity and things like that. We can't do that. That again is a breach of the legislation, and again, very, very limited circumstances. You can do it to a certain degree, but think about it best from the perspective that you can't do it. Arm's length transactions, we're required to undertake all transactions within a self-managed superannuation fund at arm's length. So where you can, it doesn't mean you can't deal with related parties, it just means you need to consider such things as, well, if this was a completely independent person that I didn't know, what would they sort of, how would they treat the transaction, and you should do it the same. Now, and the arm's length transactions extends to things other than just, you know, borrowing money, repaying money and that type of thing. So it isn't just around monetary type items. An example of that is you might have a factory that your business operates out of within the superannuation fund, and the business is paying rent to the superannuation fund to lease that property. Now, you need to have a lease agreement in place. If you were dealing with an external third party, there would be a lease in place that sort of says, here is what the lease repayments are, here are the annual increases, this is what happens if you default on your lease payments. All of those types of things are included in that particular type of document. So you want to make sure that you've got, even though you're dealing with yourself essentially, that you've got all of those things in place as if you were dealing with somebody who is unrelated. And then finally, collectible investments. I was speaking earlier about if you were buying a painting or something. So those are those types of investments. So the likes of artwork, wine collections, you know, it might be classic cars, you know, certain jewellery and those types of things, golf clubs and all of these types of things fall into these collectible investments. Now, we are still allowed to do those in our self-managed super fund, but a couple of years ago, or from 2011, they introduced a whole new regime of rules surrounding collectible investments, and we had 5 years, so up until 30 June 2016, to make sure that our funds were complying. So there's very specific rules about where the asset can be stored, insurance over the asset, if you're wanting to value the asset, getting qualified valuers, all sorts of things like that that need to be taken into account if you're holding this type of investment. Now, all of these investment restrictions and the investment rules, it's well worth, when you're making decisions as the trustee, to document those either in resolutions or minutes to make sure that you've got a record of what is occurring in the superannuation fund. Now, the other thing too regarding investments is that all self-managed super funds are required to have an investment strategy. Now, that investment strategy must be in writing. It needs to show that you've considered risk, diversity, liquidity, prudential management, all of those types of things, as well as whether the members need insurance coverage. So all of those things must be included in that investment strategy. Now, when I'm speaking about risk and liquidity and diversity, and particularly around diversity of your investment and the assets that you hold in the superannuation fund, what you want to have a look at, and you might make a decision around a particular asset. So for example, you might sort of look at, I want to buy this particular factory, and it's going to be the only asset in the fund. Now, that's not a problem. There's nothing that the ATO can say that you can't just have that one asset. The ATO are not financial planners. They can't come in and say you've made an inappropriate investment decision there. all that they're looking for is, have you considered those things? So you may just have this one asset in the fund, but you've considered, yes, it's going to pay a good income stream on an annual basis. I think it's going to go up in value. All of those things, again, getting back to our sole purpose test and documenting that in an investment strategy. Now, your investment strategy can be updated as often as you like, so it is well worth having a look at when you are looking at a particular new type of investment, or where you're looking at, sort of on an annual basis. It's well worth having a look at as well. Now, the ATO areas of focus, I just wanted to highlight these for you, because the ATO are the governing body that looks after our self-managed superannuation funds. As was mentioned, your superannuation fund is required to be audited every year, and those audit reports are lodged to the Australian Taxation Office. So they will then undertake audits themselves, so we need to know what their particular area of focus are. Now, for the coming year, the legislative changes, which I'm going to be talking about shortly, so there's been a number of superannuation reforms that were announced in the 2016 budget, as I mentioned, which are now going to take effect as of the 1st of July 2017. So we need to be right on top of those changes, and the ATO are going to be looking out to make sure that we're following those. There is some transitional provisions around certain items, so we have got some time to make sure that we are in place with these particular changes. They're going to particularly looking at the contributions and the amounts of contributions that we're making, because the limits are decreasing as of the 1st of July. So they'll be looking to see if people have got excess contributions, because that is also a revenue source for them, where there's the excess tax that applies there, as well as the penalties that apply. They're going to be looking at pension reporting, so that again is part of the new reforms, which I'll talk about shortly, making sure that we've got those reported when we need to. And also the asset valuation. So it's vital that accounts, all the assets within our superannuation fund are valued at market value each year. So what they're looking at with this regards to this ties into the changes, and particularly around that 1.6 million that we're going to be allowed to have in our pension accounts. So what they're going to be looking at there, what people might be thinking of doing is, and a property is a good example, say that you've got a property there and you sort of think it's around, it might be around 1.5 million or something like that, but you put the value as lower so that your whole superannuation balance is under that 1.6, and it can all go into pension mode. And then next year, when you update the financial statements and you're looking at the market valuation again, and suddenly that property has increased to $2.5 million, in value, the ATO are going to be looking at, well, were there significant big differences that are quite unlikely, where we've sort of tried to circumvent the changes by certain valuations. So do be careful there. Essentially, we've had a period of about 10 years where we haven't had to report pensions or these types of scenarios to the tax office when we're starting new pensions and things like that. We're now going to be, because there is going to be this cap, we are now going to be reporting to the tax office much more detail. So we do need to be careful and make sure we're doing the right thing in respect to those types of items. Now, with regards to the superannuation changes, so I sort of briefly mentioned some of those earlier. So our contribution limits are going to be reduced. So just to recap on that, so the concessional limit, so that's your 9.5% super guarantee plus any salary sacrifice amounts, that limit is going to be $25,000 per member per year, so not across the different funds. So if you've got an employer that's making multiple contributions, or you might have different employers, so for example you might be a doctor working in different hospitals, and each hospital is making a contribution on your behalf, if you go over, they can still make all those contributions. It'll just be you as the member that's impacted by the excess tax that applies to those and the penalty penalty that applies there. Our non-concessional, so our tax-free contributions, the limit is dropping down from $180,000 per member per year down to $100,000 per member per year. So these are applying as of the 1st of July. We've got the 3-year bring forward that we can still use, and for our non-concessional contributions, there is a transitional period that applies over the 2015-16 financial year through to into the 18 financial year. So you need to know what you had reported back in those times to make sure we don't go over our limits there. As far as our pension is reporting, as I mentioned, we hadn't have to report to the tax office for about 10 years in relation to our pensions when we're starting or stopping pensions, and we are going to have to report now. So that transfer balance cap is the 1.6 million that you're allowed to have in pension mode, and the way that it will be reported is based on particular events. So it's not necessarily going to be an annual reporting. So when they're talking about the transfer balance cap events, that's where you start or where you stop a pension. So where you start, you'll need to notify the tax office, I'm starting the pension with this amount, and you'll have a transfer balance cap amount. So all these, there'll be sort of entries for and against that transfer balance cap to make sure that you're not going over the 1.6 million. Where you stop a pension down the track, you'll also need to report that, and that will come off your 1.6 million balance to then so you'll be able to use more going forward. Now, so it's not going to be annual reporting, and as yet we haven't seen how this reporting is going to be done. So we need to get onto that, and I hope the ATO gets onto that pretty quick smart, because as of the 1st of July we need to report who's already over that 1.6 million limit, and so what needs to happen in order to get in place there. Now, you should be aware, if you are currently over 1.6 million, as trustee you're required to put a minute in place by 30 June to say how you're going to get your balance under that 1.6 million. If you've got multiple pensions that's across this over the 1.6, you need to outline the methodology of which ones you're going to choose to get it down under that 1.6. Now, do be careful if you've got more than one fund. So if you've got your self-managed super fund and you might have a government pension or an industry or retail fund that's also in pension mode, you need to have that minute in place across all of those balances and what you're going to do there. So as I said, so some reporting that needs to happen, but as yet we don't quite know the format for it. Now, the difference between a transition to retirement income stream, so that's the TRIS, versus the account-based pension, so that's your ABP. So for a TRIS, that will not count towards the 1.6 limit. This is what we used to call our working pension. So you could start to access your superannuation even though you were still working. So that's going to lose its tax exemption, but you can still keep paying those. So because it's losing its account tax-free exemption, it doesn't count towards that 1.6 million limit. The account-based pension will count towards the limit, so you need to make sure that you're reporting those. Now, if you're on a transition to retirement income stream, it's well worth having a look at, well, do I now actually meet the conditions of an account-based pension so that I can retain that tax-free environment there. Now, the other thing too is around the death benefits. So with the death benefits, it used to, and quite often we would have people who would have, when they'd set up a reversionary pension, which is basically on their death, it automatically passes to their spouse. So we had most of our pensions set up this way, and the surviving member, so the surviving spouse, just carried on the pension as if that deceased member was still alive. Now, that's going to change significantly from the 1st of July 2017 with these new transfer balance caps. So if you've got the situation where, so say my husband and I, we've each got $2 million in superannuation superannuation. We've got pensions going, so we've got that 1.6 million cap. So our remaining $400,000 each is in accumulation. It can stay within the superannuation environment, but is it within accumulation mode, and my husband dies. So because I've already used my 1.6 million cap, the money transferring from him will also count towards my cap. So what I'll need to look at doing, I've basically got two choices in that circumstance, is I either pay out the full amount as a lump sum death benefit, which means the money's going to leave the superannuation environment. And because of the new contribution rules, I won't be able to get that back in because I'm over that 1.6 million limit. With the, and then the remaining, so that's our first option. Our second option is I commute my pension back to the accumulation. So my 1.6 limit is now at 0. I take on my husband's pension, so I've got up to that 1.6, but that 400,000 that was over the 1.6, that will have to come in a lump sum. So we'll have to look very carefully how these benefits apply now going forward because of the new reporting requirements. Now, the last point I've got there is asset valuations, and this is specifically tied into the capital gains tax, so the CGT relief that the government has offered for those members impacted by the changes. So the CGT relief will only apply if you've got more than $1.6 million in pension, so part of your balance is now going to have to go back to accumulation mode, or if you're receiving a transition to retirement income stream, because you're going to lose your tax exemption there. One of the benefits of being in pension mode I mentioned was that 0% tax rate, and as the rules currently stand, if you sell an asset while you're in pension mode, the tax rate on the profit of those proceeds is taxed at 0%. So with the new changes and the new limits that are going to apply after the 1st of July 2017, what we're going to see is the situation where now potentially some of those capital gains will be taxed now. So they're offering this relief. Now the relief will in most instances apply from the 30th of June 2017, so the price of your investments at that point in time. You can apply the relief on an asset by asset basis, so you don't have to apply it to all of the assets that you hold in the fund. So for example, if you've got some assets that have got losses associated with them, more than likely you're not going to apply the capital gains tax relief there. And you may choose not to apply the relief. So you might have the situation where you've got husband and wife in the fund and one of them is not old enough yet to start a pension. So if you apply the capital gains relief, you're going to trigger a capital gain. So if you've got someone who's not in pension mode, there's going to be a tax that applies. You can either pay that tax now or you can defer it to when the asset is actually sold. Now the benefit of the capital gains tax relief is what you'll be able to do, and you don't actually have to physically sell the assets, but you'll be able to refresh the cost base up to the date at 30th of June. So if you'd bought an asset, say in 2000, and you do apply the relief as of 2017, the new price applies as of the price at 2017, and you're treated as if you bought the asset in 2017. So after the 1st of July 2017, if you sell something down the track, it may not have as big a capital gain on there because you've increased the cost base of those. Now, if we're making the election for this, the election is irrevocable. So once you've let the tax office know that you're applying the CGT relief, then we can't change our mind after that's been made. Now, from the trustee's perspective, your responsibility is making sure that that's notified to the tax office by the time your tax return is due for lodgement. Now the CGT relief information is included in the tax return, so if you have an accountant that's helping you put together your tax return for the 2017 year, they will be able to help you with that process. Now, finally, I just wanted to mention that essentially you're not alone in this process. As I've gone through today, there's a lot that you need to be aware of. There's a lot of legislation around superannuation. So sometimes it can feel a bit overwhelming with regards to what you need to do and what you need to be aware of. So remember, you're not alone. TAG Financial Services, we're here to help, and we can really be involved as little or as much as what you need for us to be. We can sort of go right through the entire gambit of services. We can be an investment advisor, we can help with the financial statements, preparing your tax return, assisting the auditor, right through to just helping and making sure, it might be just that we undertake the audit and you're having a look at, and we sort of help you on a consulting basis from year to year to make sure that you're making sure that you're following the legislation. So really can sort of cover all those areas. We can help with establishing the superannuation fund, as I said, the administration, the audit, helping you with your investment decisions and keeping on top of those and providing advice around what investments you'd like to make. At TAG Financial Services, we do have our own investment licence, so we are a fully independent set of advisors that are also very on top of your compliance needs. So, all the tax rules and stuff that's associated with superannuation fund, we're taking those all into account when we're providing financial advice there. And then we can also help you with the compliance, so making sure that you're following the legislation as you need to. So that just sort of outlines those. So, what do you need to do? What does TAG need to do? We'll help you with strategies. We'll help you with estate planning strategies. We've got other divisions, so our investment advisory and wealth division and our business advisory tax division, so if you've got other entities and how those other entities tie into your superannuation fund, so we can help with all of those. We can provide education, such things as these webinars or our information evenings that we run once a month, and to help you take care of your compliance obligations. What do you need to do? So you need to speak to either TAG advisors or your advisors, particularly if you're looking to do a investment or a strategy that's a bit outside the ordinary. Well worth being proactive about that. Can I do it? Does it meet the legislation requirements before you actually go and undertake? Because it can be a very expensive process to, unwind something that you've already done. You need to think about what your goals and objectives are, and then we can sort of help you achieve those. So but you need to know because that's going to be different for everybody. So what suits you, what's right for you. You need to be aware of your requirements. So, listening to this webinar, seeking to understand the legislation, get clarification. As I mentioned right at the start of the webinar, ask your advisors the questions that you're not sure about. It is your requirement to make sure that you're on top of these things, and to keep records of your transactions. So just, you're buying a new investment, that you sort of keep the, investment documentation around those sort of things. Keep your bank statements. All of that type of stuff is the trustee's responsibilities. So thank you for listening to our webinar today. I hope you are aware of what you need to be on top of as you're acting as trustee, or if you're thinking about setting up a self-managed super fund, what you need to be aware of. So please feel free to join our mailing list. You can visit www.tagfinancial.com.au or email us at team@tagfinancial.com.au, and with that you'll get lots of information, sort of tips and traps and things to be aware of, as well as information about our upcoming webinars and complimentary information sessions that we run from our office. So thank you for attending. I look forward to speaking to you next time. Thank you.